So welcome to McTear Williams Woods Norwich Insolvency Update webinar. Next slide, please. My name's Andrew McTear. I'm your chair. Whoops, we've jumped a few slides, but we'll go back. My name's Andrew McTear. I'm your chairman for this event. I'm a founder and director of McTear Williams Woods. We're going to try and get this all done in an hour, followed by a question and answer session. And if you have any questions as you're going along, if you go down to the bottom of your screen, you'll see a Q&A button. If you put your questions in there, we'll keep an eye on those, collate those and try and deal with those as in a panel session at the end. So put them in as they occur to you as the presentation's going on, and we'll try and answer those at the end. So insolvency is a bit like buses. Nothing happens for ages, and then three come along all at once. Just moving on to the agenda slide. And we're going to run through those changes in the insolvency update. Actually, I've just missed a bit, so just bear with me. Before I introduce the agenda, which you're looking at, we'll just stay on that slide. Just a few things. I've just dealt with questions. We are recording the webinar and we're intending to put that on our website. So keep the questions clean, but also if you want access to the slides afterwards, you can get those on the website together with the commentary. To keep the presentation down to an hour, we're going to be going at this at some pace, so hold on to your hats. And finally, if you hear a fire alarm, I have no idea where your fire exits are. So just moving on to the agenda, following my brief introduction, we're going to have an insolvency update from Tony. We're then going to have a refresher on all things business rescue and insolvency from Joe Watts. Then a session on top tips for directors from Hayley Watson. And then some tips on how to buy a business from an administrator or liquidator, effectively from an insolvency practitioner. I did miss one there actually, sorry. So how to avoid unlawful dividends. Obviously, that's one of the biggest pitfalls we see from Mike Jenner. And then how to keep lenders on side from Phil Bailey, who's recently joined us from Barclays, and then the Q&A. Next slide, please. Before we get into all of that, a quick bit of scene setting from me. This is a chart that we keep an eye on because it's our marketplace, which is the blue line, which is insolvency, corporate insolvencies in East Anglia. This is from 2008 right up to Q3 2020. You can see that's quite volatile. The numbers are relatively small, so if you get a group of companies or something going bust, that causes that line to go up and down. A smoother line is the red line, which is corporate insolvencies in the UK, where you can see in 2008 it spiked, then came down quite rapidly, then glided down, then went largely sideways before crashing effectively to all-time low levels since lockdown during the deepest recession in 300 years. I have to say I didn't see that coming, but it's a result of all the business support the government's been giving. The other line on the graph is the black line, which is a business distress index that we keep ourselves of all companies in East Anglia above a certain size, which are insolvent, so that is they've got a bracket at the bottom of their balance sheet, are illiquid, so that's net assets, which again are minus, and had a decline in shareholder funds in the last filed accounts, which, given that the balance sheet's insolvent, is an indication of a loss rather than dividends. So you can see there's a wide divergence, which we've highlighted, between the red line and the black line, which suggests pent-up demand for insolvencies. Next slide, please. This is a slide which shows the recovery from recessions. And it's a little difficult to read, but those recoveries have, in recent recessions from the 1970s, taken between roughly 2 and 3 years to get back to the pre-recession level of GDP. That is, except the last recession, which is 2008, which took, in fact, 5 years. And of course, we don't know about the current recession, and you can see the sharp decline and a sharp recovery so far. So we don't know how long it's going to take, but there has been a very sharp recovery, which I think is a sort of described as a bungee shape. What the rest of the shape of the recovery is, only time will tell. So next slide, please. And no presentation would be, or webinar would be, complete without a disclaimer, so we don't want to disappoint you. Here it is. Without more ado, next slide, please. I'd now like to hand over to Jo Watts.
Thanks, Andrew. So, hello everyone. For those of you that don't know me, my name's Jo Watts. I'm an appointment taker and associate at McTear Williams Woods. So the first section of our webinar is going to give you a quick run through of recent updates in insolvency legislation, and, like Andrew referred to them, the 3 buses. Next slide, please. So up until recently, there'd been few changes to insolvency legislation, but in 2015 and 2017, the way IPs are appointed, how their remuneration is approved, and how they communicate with creditors all changed. Then during lockdown in 2020, the Corporate Insolvency and Governance Act, known as CIGA for short, came into effect on the 26th of June 2020, partly in response to COVID-19, but it had mostly been consulted on since 2016. CIGA brings in a new moratorium, a new restructuring plan, a ban on termination of contracts in insolvencies, and temporary COVID-19 provisions. And the last bus is the Finance Act 2020, which came into effect on the 22nd of July 2020, introduced the joint liability for directors, and also from the 1st of December 2020, Crown secondary preference. As we will come on to, both are game changers for most SMEs. Next slide, please. So from October 2015, the way IPs can be remunerated changed. IPs used to be able to get fee approval on a time cost basis and book and charge their time with no restriction. But from October 2015, IPs have to provide creditors with a fee estimate, which, if approved, acts as a cap on remuneration that can be charged. More flexibility was also introduced, which allows remuneration to be approved and charged on any combination of the bases available, including fixed time, time costs, and percentages of assets or realisations. Previously, IPs had to choose one of the bases and stick with that. The overall aim was more disclosure, transparency, and engagement with creditors. The reality, though, is very different, as creditors are now swamped with pages of mostly unintelligible details and minimal contact. It feels to me more like a case of the regulatory tail wagging the dog. In 2017, April, the new insolvency rules were introduced, and they brought in decisions by deemed consent. This is where a decision that used to be made by creditors, like the appointment of an IP, is made without a single creditor vote, unless over 10% in value of creditors object by 1 minute before midnight on the date of the decision day. Creditors can also request a physical meeting be convened, and the rule of 10 will apply here. That is, the request must be made by 10% in value of creditors, or 10% of the creditors, or 10 creditors. Decisions in insolvency processes can now be held by deemed consent, by correspondence, by electronic voting, or by virtual meeting. But a physical meeting cannot be held unless requested by creditors using the rule of 10. The legislation changed to increase creditor engagement in the process, which hasn't really worked, and very rarely are physical meetings requested by creditors. In addition, the legislation has made changes to the way IPs communicate to creditors, which can be by giving notice to creditors and then delivering reports on their firm's website, which has been adopted by most firms. On our McTear Williams Woods website, there's a section specifically for creditors. Also, small debts of £1,000 or less can be deemed as proved without creditors needing to submit formal claims. Next slide, please. So, as we said, CIGA came into effect on the 26th of June 2020 and brought in the new moratorium and restructuring plan procedures. We'll be discussing how the moratorium works in our business rescue and insolvency options presentation. But suffice to say, since the 26th of June and up until the 30th of September this year, there have only been 2 moratorium filings made at Companies House and only 1 restructuring plan. That's because company rescue is rare outside of CBA, which mostly don't need the protection of a moratorium. We've only ever seen 2 in our 20 years. However, we can see that a moratorium would be useful to SMEs if new investors or new finance is promised, where a bit more time is required just to get the deal over the line. It is also likely that large companies will use the moratorium in conjunction with the new restructuring plan, which I'm going to talk about next. Next slide, please. So the restructuring plan is a variation of the existing scheme of arrangement and is similar to Chapter 11 in the USA, involving multiple court hearings. No one thinks it will be used by SMEs as it's too complex and expensive compared to a CBA. In a restructuring plan, 75% by value of creditors in each class has to approve the plan. Next slide, please. The restructuring plan can bind secured creditors, and the court can impose the plan on dissenting creditors. The court is only likely to do this where the plan gives the creditor class a better outcome than an alternative insolvency procedure. And Virgin Atlantic was the first company to use it. Next slide, please. CIGA also introduced a ban on the use of termination clauses in insolvencies, which extends the existing requirement to continue supplies by key suppliers like utilities and internet services to all suppliers, and just as importantly, prevents them from amending contractual terms and pricing. We don't generally see this as an issue on many insolvencies, as trading insolvencies are quite rare, and suppliers are more than happy to supply knowing they're contracting with a regulated professional. However, it will help post-appointment utility supplies where tariffs used to roughly double. And we think the most likely applications are in CVAs. There is a COVID-19 temporary exemption for small company suppliers from the period 26th of July 2020 to the 30th of March 2021. Next slide, please. In response to COVID-19, other temporary measures were also introduced within CIGA, and they include a moratorium on statutory demands and petitions where the reason for non-payment is COVID related, which was from the 1st of March to the 30th of September, but this has now been extended to the 31st of December 2020. Landlords are also prohibited from forfeiting leases until the 31st of December 2020. And there's a suspension on wrongful trading between the 1st of March and the 30th of September 2020. But wrongful trading is often raised with directors as a risk area pre-appointment, but in practice it's extremely difficult claim to pursue. And whilst it caught the headlines for all practical purposes, the suspension is a bit of a non-event. Next slide, please. With much wider potential application and largely under the radar, the Finance Act 2020 introduced directors' joint liability for tax abuse. That's with effect from the 22nd of July 2020. This places serial phoenixism firmly alongside tax evasion. A joint liability notice can be issued when 3 companies are subject to insolvency processes in a 5-year period, and the new companies carrying on the same or similar trade as at least 2 of the old companies. At least one of the old companies had a tax liability greater than £10,000 and more than 50% of total liabilities, and the relevant individual directors and or shareholders are concerned in the management of the company. Joint liability covers unpaid and future taxes of the new company for 5 years from issue, and also the unpaid taxes of the old companies. The law in this area is ready, and so the only way for directors to avoid this is to avoid insolvency altogether, or ensure that HMRC does not become more than 50% of the creditors. It remains to be seen how extensively HMRC will use those powers to make directors liable, as it has other more limited powers that are very rarely used, for example, to make directors responsible for NIC deductions. Next slide, please. And finally, the Finance Act 2020 also brings back the return of HMRC as a preferential creditor from the 1st of December this year. Like joint liability notices, this could be another game changer in our world, as it winds back the clock to 2003, making HMRC a preferential creditor, again leaving little left for ordinary unsecured creditors. Although this time HMRC are a secondary preferential creditor after existing employee preferential claims for arrears of wages and holiday pay. However, it only covers taxes collected and held by businesses on behalf of other taxpayers, such as BAT, PAYE, employers' NIC, student loans and CIS deductions. This is likely to have far-reaching consequences, including fewer and smaller dividends to unsecured creditors, more money for HMRC, less money for banks, more calls under personal guarantees, and we may find banks less willing to lend. It may also be the death of everyday CVAs, as dividends to unsecured creditors could be derisory. So that's the end of the insolvency update. I'd like to hand over to my colleague Tony Harrison now to talk you through the business rescue and insolvency options.
Thank you, Jo. So good morning, everybody. My name is Tony Harrison. I'm an associate in McTear Williams Woods. I'm going to run through business rescue and insolvency options. For many of you, this may be mostly a refresher, but I will be covering some of the new insolvency procedures. What I would say is we always exhaust the business and rescue options before we get into the insolvency options. And what I'm about to run through is in the order in which we consider each option, which is in order of least intervention. So if I could have a first slide, please. So just as with COVID-19, we have the rule of 6-2. Think of these as a cascade where we rule each one in and out in turn. If you can't trade on and out of difficulty without having to do deals with creditors, then we consider informal time to pays, we say TTPs. If that's not enough, then we consider the new moratorium, CVA, then finally administration and liquidation. Next slide, please. So of course, prevention is better than cure. If a company can avoid having to break cover and compromise with creditors, then it should. It's not unusual for businesses to have to juggle cash flow for short periods, but not all the time. As the company becomes distressed, it usually happens over a long period of time until towards the end, when it becomes rapid and directors have to fight on multiple fronts. For example, when credit insurers withdraw. If the decline is not just about cash flow and revenue and costs need to be realigned, then cut early and hard so you start to see the benefits quickly. Don't be optimistic. Make sure forecasts are brutally realistic, otherwise you might pursue this option when other business rescue options are actually more appropriate. If cash flow is tight, prepare a rolling 12-week or short-term daily cash flow forecast so you understand the cash position through each month end. If your clients are thinking of introducing last chance funding, do so safely. We have various ideas, so call us first. If the business is struggling, it's probably insolvent or near insolvent. If so, the director's duties change from acting in the interests of shareholders to acting in the interests of creditors, and to protect themselves, they should record decisions and take and follow professional advice. Case law has established that following professional advice gives directors a high level of protection. Next slide, please. So, if you can't trade on without doing deals with creditors, then you're going to have to enter into TTPs. TTPs are associated usually with HMRC debt, but we have an example of an engineering company which was facing closure as it could not fund a profitable repeat order where it had already developed and produced the tooling, so the order was worth £250,000 net profit. They approached us and we suggested that the company approached its major supplier asking for extended credit in return for a premium to be paid for the supplies it needed to complete the order. The supplier agreed, with the company giving an uplift of £25,000 for the goods paid to the supplier, so it only gave away 10% of its profit on the order, with the result that the company was then able to continue to trade on. So if a company cannot pay its debts when they fall due, then it is insolvent. But by doing a TTP, a company is then able to pay within agreed extended terms and so becomes insolvent again. In the COVID-19 era, creditors and lenders are expected to be more receptive to rescheduling payments. In particular, HMRC, whose debts can build up very quickly, is under political pressure to be lenient, and we are hearing that HMRC is open to any reasonable offer. Historically, TTPs over 3 months are a given, and it's usually possible to agree payments over 6 months, but it is rare to see payments spread over more than 12 months. Our advice is to include an initial payment on HMRC's acceptance and keep to it. There is usually no second chance. Informal TTPs with more than a few creditors are usually unworkable. Next slide, please. If informal TTPs won't work, then consider a formal moratorium using the new moratorium procedure. Once you have filed documents at Companies House, there can be no legal action against the company for 20 days, and this can be extended by creditors or the court for up to 12 months. Sounds great, but it can only be used where cash flow is so bad that the company is unable or near unable to pay its debts as they fall due, but not so bad that an IP thinks the company cannot be rescued or pay all its finance commitments and other credit incurred during the moratorium. We think these circumstances will be few and far between. Also, if the IP ceases to think that the moratorium is viable, then he or she must bring that to an end. For SMEs, it's most likely to be used in conjunction with a CVA or by time to get a refinance offer over the line. Next slide, please. So if a moratorium won't work, then maybe a CVA could. CVAs were introduced in 2003 and got off to a slow start, but with the decline in the high street and now COVID-19, most national retailers or casual diner businesses are either in or thinking about doing one, as they can be used to walk away from unprofitable outlets and reduce rents. CVAs can be used if a company just needs time for something to happen. So for example, a contractual receipt be received, to sell an asset, to refinance, to win litigation, to enable creditors to be paid in full or part. More typically, they're used to allow a company to restructure and make voluntary contributions over 5 years, but it can be used to wind down a business. However it's used, and it needs 75% of value approval of creditors, it needs to offer them something significantly better than administration or liquidation, typically 30 to 40 pence in the pound compared to a few pence in liquidation. A word of warning, however, most CVAs fail because most are based on voluntary contributions over 5 years when things do change, and also are based on over-optimistic expectations. Next slide, please. If a CVA won't work, then maybe an administration could. In 2003, administrations became mainstream when banks could no longer appoint administrative receivers under new debentures. The major advantage over liquidation is that administration creates a moratorium stopping creditors from taking enforcement, which can assist to sell a business and assets as a going concern. Most administration appointments are made by a company board of directors, but a lender with a floating charge has a 5-day window to veto the company's choice of IP and appoint one of their own. In 2003, no one had heard of pre-pack administration, but they quickly came to the fore, and even today, the majority of administrations are pre-packs. A pre-pack is where the sale of the business and assets is negotiated prior to the administration and completed soon after. Over the years, pre-packs have got a bad name. They can be seen as cosy deals behind closed doors and are increasingly regulated, so that today there has to be open marketing and detailed disclosures to creditors soon after the deal is done. And pre-packs are currently under review again, and the government has said that it will legislate so that all administration hardly ever ends in company rescue, which is its primary statutory purpose, and is ended by the administrator moving the company to dissolution or liquidation. Next slide, please. If administration won't work, then that leaves liquidation. Liquidations followed the introduction of limited liability companies in 1844, and they are used when a company has reached the end of the road. They come in two flavours. A solvent liquidation, also known as a members' voluntary liquidation or MVL, pays a surplus to shareholders taxed as capital gains rather than income. An insolvent liquidation can be a creditor's voluntary liquidation, a CVL, initiated by the directors and approved by the shareholders, or a compulsory liquidation by a court order. The latter process takes 2 or 3 months, is quite costly, and results in a civil servant known as the official receiver being appointed. Directors will always opt for CVL because it is quicker and they get to choose the IP. A run on case law in Europe and the UK has turned business rescue on its head. The Insolvency Act positions administration as a company or business rescue procedure, but case law has determined that TUPE applies to all administrator sales, so that all employee liabilities transfer to the purchaser. The same case law has determined that TUPE does not apply to business and assets sold by a liquidator. For most SMEs, whether employee liabilities transfer will make or break a sale as a going concern and therefore jobs saved. Also in a CVL, all the regulation around pre-packs do not apply. And if you follow the right procedures, a director's successor company can continue to reuse the same name. So whilst liquidation is the last insolvency option, it is definitely not the least. That's all for me for now. I'll now hand over to my colleague, Hayley Watson.
Thanks, Tony. Good morning, my name's Hayley. I'm an associate and an insolvency appointment taker here at McTear Williams Woods. At McTear Williams Woods, we see approximately 150 new insolvency appointments a year, and through those we see all sorts of directors' conduct, some very good and some very bad. And through that experience, we've identified the top 10 tips for directors that you can do to avoid the worst pitfalls. Next slide, please. As Tony mentioned earlier, to enable the directors to be able to make informed decisions, they need to know the company's current financial position, and exactly what information is required will vary depending on the size and the complexity of the business. But at a minimum, they should have up-to-date management accounts and be able to see that they have enough cash flow for the foreseeable future. If the cash flow looks tight, then we would always recommend that a 12-week rolling cash flow forecast is prepared. Directors should always have a plan B and be realistic about it. They need to know where they want the business to go, and ideally they should have integrated profit and loss and balance sheet and cash flow forecasts covering the year ahead. Those forecasts should be flexed so that at a minimum, directors have a base forecast that they can be confident can be achieved, and a more ambitious cash flow that can act as a target. If the 12-week rolling forecasts or the long-term forecasts show that the business is running out of money, then they should seek professional advice early and follow that advice. In the World of Leather case, it was found that as the directors had taken and followed professional advice, that they had acted properly. We're always happy to provide free initial advice to advisors on both named and unnamed bases here at McTear Williams Woods, or direct to your clients. Don't let Crown debts get more than 12 months in arrears. Insolvency law requires that all creditors are treated equally, but the reality is that often HMRC are left behind. If the company is more than 12 months in arrears with its HMRC debts, it's a red flag that the insolvency services will look out for, which could lead to a director's disqualification. Directors should also watch out for the joint liability notices for repeated offences where the Crown debt is more than 50%, which we mentioned earlier. We would always recommend that directors have a written service agreement or a contract of employment. Next slide, please. Directors should also stop drawing against directors' loan accounts and paying dividends if the company doesn't have the distributable reserves to do so. They should also pay themselves a fair market salary, and my colleague Mike will cover this in more detail later on. If directors are planning on injecting rescue funding into the business, then they need to be smart about it and my colleague Phil Bailey is going to cover this again later on in the presentation. But remember that rescue funding is always very risky, and directors and shareholders should be wary of ending up as unsecured creditors. We would always say that directors should have a plan B, as this will speed up how quickly they can act if ceasing to trade ceases to be an option. It also helps directors to understand their options and aids current and future decision making. And finally, you shouldn't let it get you down. If it does, the situation has gone too far. And this is a good test of whether the director should take specialist advice. There's almost certainly a better way. If you have any queries or want to know more, please get in touch. I'm now going to hand you back to Tony.
Thank you, Hayley. So I'm going to run through our top tips when buying a business and assets from an IP, mostly from the point of view of a director looking to buy his insolvent company's business and assets. And that's because the majority of the business and asset sales done by IPs are back to a former director's new company. If I could have the next slide, please. So if a director is going to buy the business and assets back from an IP, he should, or she should, want it to be in the best possible shape with its customers and its supplier base intact. If you leave it too late, customers and key employees will have gone to competitors. Also, if the decline of the old company becomes drawn out, the directors may have already put all their personal savings into it to keep it going and have nothing left to fund the new co. And of course, they could find themselves in breach of their director duties and face claims and director disqualification. As well as getting the timing right, directors need to choose their IP carefully, because they need to be sure that they will be commercial, pragmatic and fair. Of course, if directors have any trouble finding a good IP, we would always be happy to put them in the right direction. Most business and asset sales by an IP have to be done quickly, because otherwise, after a very short time, there will simply be no business left to sell. Think in terms of days, not the months that a corporate finance sale would take. So the successful purchaser needs to know what it wants to buy, how it is going to pay for it, and be able to put money on the table at completion. And that's just the start. They will need to have working capital ready and a clear plan for their new business. This all takes time, so the sooner you start to plan, the quicker you will be able to move and the greater the likelihood of success. When buying a business and assets, the IP will give no warranties other than that he or she has been appointed and has the power to sell such right and title and interest as the company has in the business and assets. Caveat emptor applies, let the buyer beware. In the COVID-19 area, the timing of the insolvency appointment and business and asset sale is more critical than ever. If they can, we are seeing directors delaying that process, although of course this runs a greater risk of them breaching director duties. Other directors are looking to buy the assets and mothballing the business until we get to the other side. Next slide, please. So when you're negotiating with an IP, it is all about the art of the possible. You shouldn't make an offer you can't deliver, but ideally you should ensure some cash is paid on completion, equivalent to the ex situ, i.e. auction value of the tangible assets. Pay some premium over the ex situ value of the assets and or for goodwill. This varies a lot depending on the business, but will typically be 50% above ex situ values. Negotiate to pay for stock or work in progress as it is used, or pay up front at a substantial discount, which can produce a super profit in year one. One thing which often gets missed is to offer to collect in book debts for, say, a 15% commission of realizations, because you know the customers and you will be wanting to deal with them anyway. If buying the business and assets from an administrator, be wary. Insist on the insolvency process being a liquidation so you can avoid TUPE liabilities. In a recent CVL that we were involved in, the employee liabilities were around £150,000, which could have saddled Newco with a very unattractive burden to start with. The employees like to be made redundant too, as they get a substantial payment from the redundancy payment service, plus their jobs back, usually on same terms. Employees with 10 years service paid at or above the statutory limit of £538 per week would typically receive a lump sum of over £13,000. Suppliers will be wary, however. Don't expect credit in the first few months. Newco will also have to provide sweeteners to secure future supplies, which could mean paying a slight premium over the list prices for a period. And remember, most major banks won't provide bank accounts or facilities to Phoenix companies. These are companies that have purchased the business and assets from an insolvent company with the same directors. So do your research ahead. That's all for me. And I'm now going to hand over to Mike Jenner.
Thank you, Tony. Good morning, everybody. My name is Mike Jenner. I'm an Associate Director of McTear Williams Woods, operating primarily out of our office in London. As Andrew said at the introduction of this webinar, one of the most prevalent issues that we see as a problem on cases is matters arising where there have been unlawful dividends and the knock-on effect on directors' loan accounts. Of the 300 or so cases we've got open at the moment at McTear Williams Woods, there's a fair percentage of cases which actually have issues arising in relation to unlawful dividends, which as liquidators we are required to do something about for the benefit of creditors. Because this is such an important topic, I've got 10 minutes to rattle through everything that I can to give you some tips on how your clients can avoid these pitfalls. Next slide, please. So we all know that most SMEs pay director shareholders a salary. We know why, and that's perfectly fine. It's a completely acceptable way of doing it, as long as there are distributable reserves to enable that process to be paid that way. So that's totally fine until you get to a situation where the company is going into liquidation, because any unlawful dividends that have already been paid may have to be overturned and returned to the company under the provisions of Section 847 of the Companies Act of 2006. And if a DLA has been expunged because of unlawful dividends being credited to it, those dividends are going to be reversed. And again, the director is going to become indebted to the company, which again, the liquidator is going to have to recover from directors. It's important to remember that dividends cannot retrospectively be reclassified, for example, as remuneration. And there's well-settled law to demonstrate that. So changing the way a dividend is categorized or a payment is categorized from originally having been a dividend to salary, unfortunately, is not going to be an option. So even if it means that the way the director has been paid for the majority of his earnings is by way of a dividend, and him having to give that dividend back results in him having no pay for the period of those dividends, unfortunately, that's not going to be a defense. And just to pile on the problems for our poor director, if the company has paid unlawful dividends to shareholders who aren't directors, there's potentially going to be a claim against the directors for a breach of duty under Section 212 of the Insolvency Act 1986 for causing or permitting an unlawful distribution to be made. So, how do your clients avoid all this grief? Well, the obvious answer is don't be paid by dividends in the first place, but obviously that's not realistic, and we certainly wouldn't suggest that that's a viable alternative. But what we do say is that when the spectre of insolvency is looming, a director can switch from dividends to salary. And we would recommend that as very much as an option. Next slide, please. Fundamentally, a director needs to have a written contract of employment or service agreement. Being paid a notional amount of salary through payroll is perfectly fine when there are distributable reserves to pay dividends. As soon as those distributable reserves dry up, switching to payment through payroll is the way to go. And as long as the level of salary is a market rate, there's not going to be any issues from that. There's not going to be any criticism from the liquidators, nor is it going to likely give rise to any areas of concern from the Insolvency Service in relation to directors' disqualification. Another benefit to the directors who've been in long service with the company, who have a service agreement or a contract of employment, is that they will be entitled to claim from the Redundancy Payments Office when a company goes into liquidation, and that could be a 5-figure sum. Next slide, please. It's important to ensure that any expenses a director incurs are reimbursed as they go or posted against the DLA on a regular basis. It's also important to ensure that the DLA doesn't accumulate, so ensuring that interim dividends that the company can lawfully declare are regularly posted against the DLA, bearing in mind, though, that interim dividends have no legal standing until paid or posted in the company's records. And fundamentally, it's essential that the director keeps on top of the company's financial situation and reacts to that immediately there's an issue, even if it's only a temporary hiccup and they need to switch to payment through payroll on a temporary basis and then revert to being paid via dividends if the company has managed to surmount its financial issues. Also bear in mind that even if there are distributable reserves, a director still has an obligation to act in the interest of creditors and needs to consider the effect that the payment of a lawful dividend might have on the company's cash reserves and the ability to pay creditors. If a director's paid a creditor under a personal guarantee, this can be set against the DLA. So that is a very, very quick run through of what we consider one of the most prevalent issues in insolvency, certainly that we see. We could probably devote an entire webinar to this subject, and it's entirely possible we might do in the future. But in the meantime, we did send out an e-shot on the subject, giving a bit of guidance back in April of this year, and that's available on our website if you'd like to download it. I'm now going to hand over to Phil Bailey.
Good morning, my name is Phil Bailey. I joined McTear Williams Woods this year following a 28-year career with Barclays. In the last 10 years, I've headed up a recoveries team, and I've also worked as a turnaround director, helping SME companies avoid going to recoveries in the first place. I'm now going to talk about how directors can keep their lenders on side and illustrate this with a few examples. Next slide, please. If the business is in distress, be very, very clear about what is possible. Do not go to the bank unprepared. Even if you've got a very friendly manager, beware. They are not the ones that are going to be sanctioning the lending. There are a lot of nervous sanctioners out there at the moment. If a case does go to recoveries, it's likely there'll be a case review, and they don't want to be the last person who advances monies before a case goes into recoveries. Remember, this is not a normal negotiation between two equal parties. Do not go in high, hoping for at least a smaller amount. This may cause more distress to the bank and to the directors. It'll be declined, and they may be put in special measures. Ask for a smaller amount and be very clear what the extra advance is for and when it'll be repaid. Do remember, under promise and over deliver. If you said you get the overdraft down within 6 months, then do so on the time you said you would. Be brutally realistic, as we've mentioned before, about your planning and your financial planning that you provide. Don't miss any milestones. I have known directors to ignore some of these, and then formal demand swiftly follows by an LPA receiver contacting them. If you have to deliver bad news, then it's best you have the solutions in place ready for the bank. Do have several scenarios available, and do come and talk to us beforehand. The bank may ask for an independent review, so seek advice in advance, and it's best to have that prepared, then you have control. Personal guarantees. These are always payable on demand and gives you very little control. They're nearly always limited. If you do find you have a director or shareholders or parties to the company that have unlimited guarantees, do please contact me. These should be a thing of the past. Once they're in place, they're very difficult to get rid of. Even if the company has repaid all its debts, when you ask for the guarantees to be released, the general answer is, well, we're not going to call upon it because there's no debt to be repaid. You might as well keep in place in case you need it in the future. As we mentioned before, if you are looking to put monies into the company, it is probably best to buy company assets. Banks do like it when shareholders, directors and owners put money in themselves. And if you ask for assets in return, that's usually well looked upon, because the bank in a gone concern has very little value on some of the assets. If it's a large amount or a large asset, then do seek the bank's permission first. But generally speaking, the injection of cash is a positive sign. We often hear directors say who've put money in, haven't spoken to us first, they end up as an unsecured creditor, and as they wish they'd spoken to us first beforehand. Finally, I want to leave you a thought that many directors and owners, when I was in recoveries, said, I wish we'd done this sooner. I wish we'd sought advice and it wasn't as painful as they first thought. So please do try and have that difficult conversation with your clients. It's better to have it as soon as possible. It gives us more options. An example I had of this is a very large hotel, a country hotel. The director, his ambition was always to run this large country hotel, and he was refusing to sell it, as it was always been his plan. But he was clearly out of his depth, and he was more used to looking after the front of house guests, and he was not comfortable with financials and the occupancy rates. At one crucial meeting, I do remember he actually got up and started laying tables rather than talk to us about the impending HMRC problems and creditor problems that he had. To unlocking the problem, we soon got him to realise that running a large B&B was better than running a large hotel, and that's what he's successfully doing now. Once he'd seen this, we managed to get the right support in place, get the agents involved early, get the bank to spend some money on improving the facilities, and the sale was achieved very quickly. So I would encourage you, the sale is not the end of the process. As I say, a lot of clients would wish they'd sought advice sooner and avoided the hardship and many years of pain before resolving the problems. So if your clients have any issues, please do get in touch with us and make sure that they seek advice as early as possible. And I'll now hand you back to Andrew.
Right, so we are finishing almost spot on an hour after we started, albeit we did start a couple of minutes late, so well done team for catching up. I think Charlotte is now going to change the screen, and Mike Jenner's taking a picture of himself by the look of it. As you can see, here is the panel, and the marketing McTear Williams Woods box at the bottom of my screen is Charlotte, who's very shy and not showing herself. So this is an opportunity to ask questions. and we've got we've got one. I'm not sure if you can see who it's from and what the question is, but anyway, I can. So it is what amounts to open marketing that has to be done before a pre-pack business and asset sale, and how do we go about that without alerting the creditors and competitors? So I don't know who would like to have a go at that between Tony and Joe. There we go. You've got about 2 seconds notice. Or perhaps both of you would like to say something.
Well, I don't mind kicking off, Andrew. And if Joe's got something to add, that would be perfect. I think for us that is one of the most difficult things to achieve. It is a balancing act. The answer is it's the widest advertising that can be done that doesn't fundamentally threaten the business, because if it did, it would defeat the object of what's trying to be achieved. Often we approach yes, competitors, suppliers on a no names basis. We bind them into confidentiality agreements, and we have to do this with very careful timing so that in the run up to a pre-pack, the company is able to continue to trade. Because in the end, what we're trying to do is achieve the better outcome, and if it ceases to trade, clearly there isn't going to be a better outcome. We also have a specialist website that we employ, which is ip-bid.com, and all our insolvent business opportunities are advertised on there. In the end, at McTear Williams Wood, we have to be comfortable that we can justify not only to creditors but ourselves that we have achieved the best that can be done in the circumstances, and that is something that we always ensure that we do. Joe?
I don't think I've got anything to add, Tony. I think you've pretty much covered it. Thank you.
There you go. You stitched Joe up nicely there, Tony. Good. And we got another question here. And this is for Mike Jenner, so listen carefully. I shall say this only once. So Mike, clients taking dividends when they've received either a bibble or a sybil, is that allowed if the company is about to go bust?
Right, okay, thanks. I'm going to throw that back to Andrew because that's completely thrown me, and I can only be spontaneous given about 7 days notice, so I'm going to ask Andrew what his view is.
Okay, good one, Mike. Basically no. If the normal rules apply on dividends, if they're unlawful because there aren't distributable reserves, or because the company is insolvent or near insolvent, then the dividend is going to be susceptible to being reversed, and then you're left with well, here obviously it's the dividend actually being paid rather than being set off against a loan account. So yeah, I think it is a potential problem area. And you know, it probably is going to be ground that insolvency practitioners are going to cover and face when corporate insolvencies start to rise, because I'm sure there are a few directors that will have jumped on that. How's that for an answer, Mike?
It's exactly what I would have said, Andrew.
Oh, perfect. And we've got another one here. I'm just reading it as out loud as I see it. Really looking at the fact that they've taken dividends when they've declared the company is in distress, which is the wording on the BB loan application. Really looking at the fact that they've taken dividends when they declared the companies. So I'm sorry, I don't quite understand that question. I'm going to have to myself pass on that, which I am doing much less gracefully than Mike Jenner just did. So another question that we've got is what's caused the corporate insolvencies to reduce significantly and what's going to cause them to rise again? So the Bank of England has said that we're in the deepest recession for 300 years, but pretty much corporate insolvencies halved. There is some sign of corporate insolvencies increasing a bit, but they're still well below pre-COVID levels. And I think the thing is that a lot of companies have got more cash than they're actually used to having, and possibly than they've ever had, because they've got their bibble, they've got their civil, they've got their VAT deferment, they've got their grants. And yes, they're probably burning through that, but they're doing that at different rates, and they're not out of money yet. But we are beginning to see companies running out of money. Tony and I are working on a liquidation at the moment. And if you look at the cash flow, you can see as clear as day that COVID happened, sales crashed, the bibble came in, they've lived off that bibble or been able to live off the bibble for 5 months. That's run out, it's the end of the road, and it's now liquidation. In that case, they didn't take it as dividends, but they did take it as salary. So they obviously were anticipating everything that Mike Jenner's just been talking about, and that's, you know, one of the early examples that we've seen. In terms of you know, when will we get back to pre-COVID levels? I must admit I thought that would be with the end of furlough at the end of October, but of course that's just been extended, and I think realistically we're not going to get much increased corporate insolvencies until next year now. So that's an answer to that question. Another question we've got here is, well, actually associated with that also is a lot of directors are putting off decision to close the business because quite rightly we're in uncertain times. No one knows how this is going to pan out reliably, and they're waiting to see. And whilst they've got the ability to do that with a bit of cash in the bank and able to pay essential bills, then it is understandable that directors will do that. They aren't going to want to liquidate their company unless they really have to. Also, I think, as Tony touched on, some directors don't really want to start a new co and saddle it with overheads when sales are still so low. So perhaps when business starts to pick up is when we'll see more action taken by directors. Okay, one more question, and then unless any more appear on my screen. Oh, there are some more on my screen actually, so let's have a look. So we've got a question here which might be for you, Mike. Do the same rules read DLAs apply to majority shareholder loan where that shareholder has a loan but is not a director or employee?
It depends. I mean, first and foremost, even if the recipient of the dividends isn't a director, if he's a shareholder in it and there's a loan and the dividend is just being used to reduce the indebtedness to the company, potentially that could be a preference claim against that recipient, possibly, which would overturn the dividend and just return the DLA to or rather the loan to an overdrawn state. It could also be a claim against the directors for causing or permitting that dividend to be paid.
Okay, thank you, Mike. We've got another question here. What do you suggest the company does next if they've taken their civil and are paying salary, but business is quiet? I think realistically, whilst directors have got some cash in the bank and are able to keep the show on the road, most directors are going to do that. It's extremely difficult to forecast how quick the recovery is going to be and how quickly their sales are going to return to a level where the business is viable. And I just don't think the courts are going to jump on directors very hard for taking, if they're taking an optimistic view. They should have forecasts that show the business can trade out, and I think as long as they've got that and they're recording the reasons for their decisions to carry on, it's going to be difficult to criticize them, and that is what I would suggest. We've got another question here which starts not a question. If there are redundancy considerations for the business, there are legislative requirements requiring consultation and contractual payments for notice pay and holiday pay. These all need to be considered or made before a company is insolvent. So perhaps when you say is insolvent, you're thinking is put into an insolvency process. So yes, all the usual rules on consultation apply, and also all the rules on selection of employees for redundancy apply, and the fact that insolvency is in play doesn't change any of that. There is a contradiction really between employment law and insolvency law, which is that employment law says you have to do all that, and for a large business that's 45 days of consultation. For example, that does only apply to companies with 20 or more employees, consultation, and if the cash isn't there to pay the employees, most directors will not ask the employees to continue working and would rather start the insolvency process. So there is tension between insolvency law and practice, because the insolvency law is don't continue to run your creditors up if you can't pay them, but the employment law is you've got to go through all this consultation and so forth. So I hope I've answered that question. I'm pretty much, oh, hang on. So can I touch on clients using BIBL or CIBL for payment of debts, which they are personally liable for in respect of preference creditors? So, yes, so if you've got a director who's guaranteed some of the suppliers that are sat there at the point of insolvency as creditors, and they're using the BIBL to pay them, is that a preference to in favour of the director? So my view on that is, as long as it's not contrived and it's payments made in order to keep the business going on sort of for commercial reasons, that shouldn't be a problem. But Mike, what would you say about that?
I'd agree with you, Andrew.
Perfect. Good answer. Okay, so I think we're at the end of questions. Does anyone on the panel want to add anything? This is your moment if you do. I'll take that as no. So thank you very much, everyone, for attending. I think we topped out at 69 attendees. and we're just down to 48, so thank you for staying on, and I hope you enjoyed that. We have got a, if Charlotte shares her screen, we've got a survey, and I must admit, are you going to do that, Charlotte? Are you there? Not once for yes, twice for no? Perhaps not. Perhaps we're having a technical problem.
There was a bit of an issue, Andrew, with that.
Okay.
Yeah, I still haven't got the poll up. It's not coming up. So.
Not happening. Right. Okay.
Happening.
All right. So there's no poll. I have to set up poll. Well, it is a poll, but it was a little survey so you can tell us how you found it. But if you want to drop us an email or whatever afterwards, we'd be grateful for any feedback. This is actually the first one of these we've done, so I hope that isn't obvious. Thank you for attending, and we hope to see you soon in person when we get to the other side of all this. Thank you very much.